Good morning, everyone, all of our guests and board participants today. Welcome to the May 20th, 2021 board meeting. Just a few housekeeping items. As you'll see on the screen, there are meeting materials that are available on the CalHFA website. There will be postings once the meeting's over with recordings of the meeting. If you are a member of the public and wish to speak during the public comment section, just be cognizant that the meeting will be recorded and available on our public website. There will be also an option for during the public comment section to identify yourself as wanting to speak. You can do that simply by just using the raise your hand function, and we'll call on you. There'll be some additional instructions at that time. I think at this point, I wanted to point out there are a couple of handouts in your control panel on the tab. You can access those during the meeting. And I'd like to pass the meeting, some more meeting instructions over to Claire Taryanan, who is our board secretary.
Good morning, everyone. Thank you so much for being here. Nice to see all of you. As a quick reminder and a request, I wanted to ask that you please do raise your hand and be acknowledged by Chairperson Prince before you commence speaking. In virtual meetings, this is particularly important because we want to be ADA compliant. We want to make a clear record, and we want to make sure that the recorded meeting is accessible to all members who are interested in reviewing the board meeting. So if you have questions around that, I'm happy to take them. And I just want to thank you so much for doing that. Appreciate it.
And with that, thank you, Melissa and Claire. Welcome everyone to the public meeting of Thursday, May 20th of the California Housing Finance Authority. As you have heard, I am the acting chair, and so Chair Gunning is able to join us a little bit later this morning. And I just want to say good morning to everyone, those who are panelists, and as well as those who are tuning in and participating. With that, I'd like to turn it over to Melissa for the roll call.
Hey, Ms. Avila Farias.
Here.
Thank you. Ms. Gallagher.
Here.
Ms. Gunn for Dr. Imbassiani. Mr. Gunning. Mr. Hunter. Ms. Johnson Hall. Treasurer Ma.
Here, and I have to leave at 11:45, so if it runs long, Noah Starr will be my proxy.
Thank you. Mr. Seeley for Mr. Velasquez.
I'm here.
Secretary Castro Ramirez, or representative from BCSH. Mr. Prince.
I am here.
Mr. Russell.
Present.
Ms. Sotelo.
Good morning, present.
Mr. White.
Present.
Ms. Campbell for Ms. Gordon.
Present.
Ms. Miller for Ms. Bosler. And Director Kavir.
Here.
Chairman Prince, we do have a quorum. Thank you.
Great, fantastic. With that, my agenda, of course, just timed out. I think that's so funny. Of course, that's going to happen. I think we are on the minutes. Are there any comments or changes to the minutes? Hearing none, as our protocol, they will be entered into our record. And then that, I think, leads us to the chairperson and executive director comments. I wish I had some chairperson comments. I think we'll reserve some time when Mr. Gunning joins us to actually give a chairperson's update. And with that, I turn it over to Acting Director Kavir for his comments.
Great. Thank you, Chair Prince, and good morning, members of the board. The agenda is pretty full today, so I'm going to keep my comments brief. Today, staff will seek the board's approval for our strategic business plan and operating budget for fiscal year 21-22, after which you will hear an update on the U.S. Treasury's Homeowner Assistance Fund established under the American Rescue Plan Act of 2021 and what role CalHFA is slated to play in the administration of these funds. And finally, staff will provide the board with an update on both the mixed income program and the wind down of our special needs housing program. Before we get started though, I do have a couple of general updates. Last week, Governor Newsom laid out his comprehensive $100 billion California comeback plan for fiscal year 21-22. And for housing, the two main goals are to help Californians stay in their homes and to continue to focus on affordable housing production. To that end, the governor's plan proposed $9.3 billion in housing investments using both state and federal resources. The biggest chunks of that are going toward rental relief and to expand the Home Key program. There's also $1.75 billion to help HCD move its backlog of projects in need of tax credits forward to the construction or to break ground. And for CalHFA, the proposed budget contemplates allocating federal funds for augmentation of our first-time homebuyer assistance programs, as well as for expansion of our planned accessory dwelling unit program. For the first-time homebuyer program, CalHFA would receive $100 million under the proposal, which would be deployed under our current program guidelines, but would target greater assistance for those at the lower end of the sustainable homebuyer income spectrum. For accessory dwelling units, CalHFA would receive $81 million in federal funds to augment the planned CalHFA ADU program that Homeownership Director Tim Hsu shared with the board at our last meeting. CalHFA is planning to launch a statewide program later this summer that would use the $19 million of AB 101 funds to leverage private financing and help defray the costs associated with permitting, impact fees, and closing costs for ADUs. So the proposed investment in the May revise would turn our $19 million sort of program that we had set up into a $100 million program, and we're hoping that it'll be impactful in the ADU space across the state. By way of update on our housing counseling program, in March, I told the board that the National Mortgage Settlement Housing Counseling Program was up and running, and we have received our first quarterly reports from our HUD intermediaries. As a reminder, the housing counseling is provided through 3 HUD intermediaries who are overseeing 80 housing counseling agencies that employ over 500 HUD certified housing counselors. We're still auditing the first quarter data submission, but we can provide some unofficial numbers that should give you an idea of how services are progressing thus far. There have been about 5,000 families that have received counseling sessions, of which about a third of those have been renters. The board will remember that we've targeted our marketing efforts towards underserved and socially disadvantaged communities, and the preliminary figures are showing that about 32% of the families that have gotten services are Latino, 31% are white, 16% are Black, and 15% identify as Asian American Pacific Islander. The data also shows that 51% of the counseling sessions in the first quarter were for home buying counseling, which includes financial management, pre-purchase and post-purchase assistance. 19% were for reverse mortgage inquiries, 15% for rental assistance, 11% for foreclosure prevention, and 4% for homeless assistance. It should be noted that even though the services are heavily weighted towards home buying right now, the feedback that we're getting from our intermediaries and the counseling partners is that they expect a huge boom in renters and foreclosure clients once the current moratoriums on eviction and foreclosure are lifted. In terms of where the services are being provided, roughly 58% of the families served are in Southern California so far, 36% in Central California and the Bay Area, and 6% in Northern California. That's it for my updates at this point, and I will turn it back over to Chair Prince to kick off the agenda.
Sure. I just want to say thank you for that update. I think all of us are looking anxiously and excitedly towards the investment that's happening at the state level and at the federal level. And I also know Treasurer Ma's got some really exciting ideas to invest in housing. It's really exciting times right now. So thank you, Acting Director Kavir, to bring us up to speed on how that is impacting CalHFA as well. I love it that Secretary Castro Ramirez gave homage to the UCLA Bruins with the roaring back kind of theme. I'm just going to say that's UCLA. I should take a moment. Are there any questions or comments from the panelists for Don? You're going to let him off the hook that easy? Well, with that then, we can move on to the next topic, which is item 5, the discussion, recommendation, and possible action to adopt a number of items. I'll turn that over to you.
Great, thank you.
Excuse
Good morning again. Oh,
we skipped item number 4.
oh, yes, we did.
Oh, we sure did. Sorry. Ms. LaBouffe, would you like to give us an update on the Executive Director Recruitment update?
Yes, thank you. Good morning, members of the board. I'm Jennifer LaBouffe, CalHFA's Director of Administration, and this morning I'm going to provide you an update on the recruitment process for a permanent executive director. Since I last spoke to you in March, the governor's office has been actively gathering names of potential candidates from a variety of sources, including BCSH's network, other referrals, unsolicited applications. CalHFA's own national recruiter identified 13 potential candidates. BCSH has initiated preliminary interviews of interested candidates, and the governor's office then conducted their own interviews. Earlier this month, the governor's office reported that they had narrowed the list of candidates down to some very solid prospects. They are still interviewing candidates and expecting to have a final set of recommendations in the coming weeks. And once they are finished with their process, the governor's office intends to connect with CalHFA's board before making their final decision and appointing CalHFA's new executive director. That's all I have as an update, Acting Chair Prince, if anyone has any questions.
Are there any questions or comments from the panelists? Claire, am I supposed to ask if there are comments from the public on each item or not?
No, sir, you can wait until later in the meeting to do so if you choose.
Okay. No comments or questions from the panelists. With that, then now.
I'd like to just recognize a few more board members who have joined the meeting since we started, and that is Ms. Gunn for Dr. Imbasiani, Ms. Tina Johnson-Hall, Ms. Von Koch-Liebert for Secretary Castro Ramirez. Thank you.
Great, thank you. Don, I'll turn it over to you.
Great, thank you very much. Good morning again, board members. For the record, Don Kavir, agency's acting executive director, and this morning my colleagues and I are here to present the agency's fiscal year 21-22 proposed business plan and operating budget for your approval. Next slide, please. The development of the agency's business plan is a deliberative process that occurs over many months. It's a living document that serves as both the roadmap for our business decisions and throughout the year and as a barometer of our success. We begin the planning process in December, and by January, the agency's senior staff are engaged in multiple all-day business planning sessions where we evaluate the mid-year results of the current fiscal year, revise our projections, discuss market trends, and vet new ideas for goals and initiatives in the coming fiscal year. Directly following the business planning sessions, each department is tasked with the development of a departmental budget that supports the achievement of the goals outlined in the strategic business plan. And next, we conduct a board workshop in March to provide a progress report to the board on our current year business plan and provide the board with a preview of some of the proposed initiatives for the coming fiscal year. And then finally, in May, we're here today to adopt that proposed business plan and operating budget. Next slide. As we discussed in the board workshop in March, fiscal year 2021 has been a strong year for CalHFA, despite wrestling with the challenges and uncertainties imposed by the global pandemic. Through the hard work and dedication of CalHFA's staff, our single-family lending program has exceeded its lending goals for the fiscal year and expects to serve over 8,000 first-time home buyers to achieve their dream of homeownership. Similarly, our multifamily lending program has done a great job with the deployment of our mixed income loan program and the expansion of our conduit lending program, which has resulted in a record-setting year for multifamily, in which they expect to finance over 6,000 units of affordable housing by the end of the fiscal year. Without sacrificing the integrity of our core business lines, we have also stretched our organizational capacity and expertise to implement a statewide housing counseling program available to renters, homeowners, and landlords using funding from the National Mortgage Settlement Funds to help families navigate the myriad of housing issues they face during these uncertain times. Additionally, a great deal of time this year has been spent designing the framework for a new mortgage relief program to assist homeowners in distress using both National Mortgage Settlement Funds as well as the American Rescue Plan Act funds from the federal government. We expect that the program is going to be about a $1.2 billion program, and staff are operating with a sense of urgency to move this program forward, working in concert with our federal partners. And we're well aware of the looming time frame around the lifting of eviction moratoriums and foreclosure moratoriums. So before I turn the conversation over to my two colleagues to discuss their plans for 21-22 fiscal year, I'd just like to remind the board quickly about the foundation of our business plan, which is our three primary goals. So our first goal, next slide, please. Our first goal is to promote statewide affordable housing production and opportunities for homeownership while maintaining financial independence and flexibility in the marketplace. Our second goal is to promote operational efficiencies through the use of technology and the implementation of best practices. And third, to collaborate with other housing entities, both public and private, and stakeholders to complement CalHFA's lending objectives and policy priorities to deliver effective, inclusive, and innovative housing solutions. With that, I would like to turn the conversation over to our Director of Homeownership, Tim Sue.
Can you all hear me? Okay. Good morning, Chairman Prince. I look forward to saying that, President.
You're
members,
the only one,
Tim. And members of the board, it's my honor to be here today to report to you our plan for this coming fiscal year. The one thing I will preface the single family business is to say that it is true that this has become a mature business in which, to some extent, I think that I think that the expectations are high, and that it's becoming sort of routine for people to expect us to do multi-billion-dollar business year after year. I would say, though, there are a lot of people behind me who work really hard to make this happen. The single-family lending space, I think you all appreciate. It's extremely competitive. It's extremely dynamic. It's changing all the time. I went back to my notes for this particular board meeting a year ago, and at that time, what we were worried about was that lenders were consolidating because rates were high, and they were sort of like consolidating, and sort of like we were losing lenders in our network. So it's a lending landscape that is changing all the time, and there are a lot of people behind me who are helping to make this becoming a multi-billion-dollar business year after year. And I just want to sort of remind the the board that, there are a lot of people whom I represent who work really hard to make this happen year after year. So as Don mentioned, our single family goal is also not as simple as just sort of hitting, multi-billion-dollar year after year. We do have a very important component that a lot of our lenders are probably less concerned about, which is that we want homeowners to be sustainably put into their homes. So we promote sustainable homeownership through these overlays that I've talked about before. And so that's one really important objective of our program. And another really important objective of our program is that we're constantly expanding our eligibility and product types and making our programs more inclusive over time. And so, for example, this year, the one big thing we did this year, which I think I also mentioned to the board multiple times, but it's worth sort of emphasizing. So one big thing we included this year is the 203 HUD's 203H program, which is their disaster relief program. So we aligned our own disaster program with FHA's disaster program to make it into a more effective and powerful program. Every year, I am a cautious person by nature, so I'm sort of a glass half empty kind of guy in the sense that, and as you all know, I also, perhaps that comes because I also run the finance department. I will talk about our business targets, but we're very cautious. As Don mentioned, there is a recovery underway, but everyone, I think, hears a lot about the challenges in the recovery. And one of the things I had thought about, some 12 months ago was, in a way, kind of playing out today, is that during the pandemic, there was a very intentional redirection of resources. And that redirection of resources is something that we're trying to sort of turn back today. And that process takes time and it can be painful. And the recovery itself could be challenged and be painful. So we're very cautious about what the next 12 months hold. And the affordability inventory is also extremely challenging. One of my favorite stories when I sometimes look at the borrowers that we have, and this is just a great story, was that last year during the fire, we looked at someone to check to make sure that their house is still there so we can close the loan. And it just turns out, when we talk about affordability, this house was up in the sort of the woodsy area of Reddings, and the individual lived on Sleepy Hollow. And but it turns out it went unscathed, and we were able to close the loan. So sometimes the point of the story is that affordability sometimes is not where we perhaps live, and we are very privileged in that way. Sometimes affordability are in sort of far reaches of the state. So with that as a preface, I want to talk about sort of our business targets. Our target for the year is $3 billion, and that is a $1 billion increase versus last fiscal year's original target, and that is $400 million higher than our revised target for this fiscal year. I'm going to talk a little bit about sort of I'm sort of emphasizing the word original and revised. I'll talk a little bit about that on the next slide. And as the board knows, our program works because we provide the down payment assistance that first-time home buyers need to get into their first home. So that $3 billion of first lien lending does require about $90 million of down payment assistance, which is a fund that we administer for the state of California. The mortgage assistance program, Don did talk about this. This is something that we've been working on for quite some time. There's the next agenda item speaks to this particular item more, so I'm going to sort of delay my comments on that to the next agenda item. And Don also mentioned that in the governor's May revise, there is $81 million of provision coming to CalHFA to augment our ADU program, and also $100 million for down payment assistance to augment our own down payment assistance. That didn't quite make it onto the slide because that is sort of hot off the press from last week. I would say though that the programs that we are running, the ADU program, which Don spoke to, which is the $19 million, and also the down payment assistance program that we run, these are the state's dollars. These dollars are coming to us from the May revise. They are federal dollars. And for those of you who work with federal dollars, you know that sometimes they come with a different sets of requirements, to say the least. And so right now, what we're in the middle of doing is, for the lack of a better word, doing a gap analysis of understanding the ARPA requirements, the American Rescue Plan Act, the ARPA requirements versus our program requirements, to figure out what the differences are, or whether we can use them on top of our existing programs and serving how should I say, sort of the targeted population ARPA wants to serve. So one example is that ARPA does call out qualified census tract residents. So we're trying to figure out if we can simply layer on top of our programs, or if we have to create a separate program for the ARPA dollars. So I'll pause there. Those are my comments for this slide. I'll take any questions sort of slide by slide if that's desired.
You've triggered a number of questions for me, but before I do mine, are there questions from other panelists? I'm looking to see hands being raised. Melissa or Claire, do you see any that I don't?
No, sir, I see none.
Well,
So
then,
there, Mr. Kranz, there will not be the option to raise your hand. So if you have a comment, please feel free to just speak up and be recognized by the chair. Thank you.
that would be great. Anyone like to be recognized, or a question for Tim? I'll throw out two. I would like to know, how would you be able to increase your target? As I heard you, you said it's from up to 3 billion from 2 billion last year. Is that correct? Okay, so we all know right now the housing crisis, particularly within the homeownership world, has become really difficult, where there's a lot of purchases that are happening with all cash buyers. I mean, multiple offers happening on homes. So how can you expand our footprint? Is that kind of just taking a larger share of the market for first-time home buyers, or is there a production that's also happening within the area of home ownership? I'm just kind of curious about, how do you expand within this very difficult home ownership environment?
Your question sort of brings forward a thought I have. The next slide, and let me talk about it now. That it is true that the original target that we have for this fiscal year was $2 billion, but I mentioned that our revised target was nearly $2.6 billion. There's a slide later on that shows that. So we're not $1 billion apart. We're about $400 million apart. And the importance of that is shouldn't be sort of skip over, in the sense that today we're bringing to the board a target for something that will accomplish starting 2 months from now for the following 12 months. So there's a lot of things that can change for sure. And one of the things that Don also mentioned is sort of the cadence of our business plan target and reporting back out to the board, and also sort of revisions. So at the March board meeting, we come to the board after having gone through 6 months of the business cycle to revise our targets. So that, as you know, for, let's say, private companies, they do that every quarter and then sort of beat their earnings by a penny, because they're kind of like controlling a lot of variables, and they do things sort of, you know, they change those numbers very frequently. So then I think that that's something to keep in mind as we sort of look at the next couple of slides. But having said that, some of the elements that we did do during during this last 12 months in the COVID crisis, we did tighten our credit box as the lending landscape tightened the credit box. So one of the things that we did do was that we did tighten our DTI, our debt to income ratio, from 45 to 43 at some point, as in sort of the spring and summer of last year, when the entire landscape was tightening its credit box, we did that just like everyone else. But we have since loosened it back out to 45. So things like that, as an example, Chairman Prince, are part of the reason why we think that we could bounce back a little bit stronger versus what we have done in the last 12 months.
And then what about the overall market for first-time home buyers? I mean, what is happening there statewide?
It's extremely challenging. I know what you mean by cash buyers. I mean, sometimes I look around my neighborhood, which is, it's a decent neighborhood, and I look around and say, it's not clear to me I could afford buying into this neighborhood today. And when I did, I was a first-time home buyer. I can't, I don't have a crystal ball to answer that question. I would say this though, that our average loan size, even today, for between conventional FHA is only about 330, and that's roughly about 350 for conventionals and about 310 to 320 for FHA. As you know, we do more FHA business than conventional. So our business model here has always been that we provide the tools, the requisite tools, the down payment assistance, the closing cost assistance, and a competitive first lien loan. And the lenders and the brokers and the consumers find the inventory. And so far, they have been able to find the inventory. And I can't tell you, we don't have the requisite tools to sort of find them and guide people to these inventories. That's not, that's sort of beyond the scope of what we do, but they are finding them.
All right, thank you. And then I think all of us are excited and committed to a process or programs that are inclusive. Can you talk a little bit, are there specific strategies around reaching into the Black, Indigenous, and people of color communities to make sure that home ownership is a growing option for them? Like what is happening within this that, because you stated inclusive, so what's unique about us right now?
I love having you as the chairman. There's a lot of questions. So I would first mention that about 6 to 7 out of 10 of our borrowers are Black or Brown or Asian American and Pacific Islanders. So that is a number that I know that board member Tina Johnson Hall has always said that it's something to be. We're extremely proud of what we accomplished in terms of the inclusivity and also demographics that we reach. Having said that, when Tia was here, she launched a homeownership initiative of outreach to the Black and Brown community, I shouldn't say it, to the African American Black community. I am not directly involved in that outreach effort. Kathy can probably speak to that outreach effort more. I would say this though, is that I think that at the last board meeting, I do this comparison in which I compare the breakdown of the demographics of our borrowers and the breakdown of the demographics of the state. We significantly outperform in terms of Hispanics, meaning that I don't have numbers off the top of my head. I think that we disproportionately do something more like 10% or more in Hispanic business than we do than the sort of the representation of Hispanics for the state. But for the African American Black community, we do outperform, but the margin is much, much smaller. So making a conscious and intentional effort to reach out to Black communities is something that is definitely part of our operational business plan.
I would just add really quick, if I could, Chairman Prince, that we have I think I mentioned it in my comments at our last board meeting, that we have a Building Black Wealth initiative that our marketing department is pushing forward, and we're working with ethnic media. We've got a whole variety of video series targeted at the African American population in order to help them avail themselves of the resources that we have here at CalHFA. And so, and we intend, through later in the presentation, that's one of the key aspects of our business plan is affirmatively furthering fair housing and helping to do what we can as CalHFA to break down barriers for populations that have historically been discriminated against and provide them opportunities to build generational wealth. And so, some of the stuff we'll do, I think, is probably nothing new in terms of marketing campaign, but we do have some very targeted marketing efforts that we're trying to get the word out and expand our resources in a way that makes a meaningful impact. So
great. Thank you. Yes, Ms. Gallagher, and then Mr. Russell.
Yeah, can I just a follow-up question? So the demographics is interesting. One of the things we keep hearing and reading about is the dislocation impacts of the pandemic, with people leaving the cities and the coasts and maybe the state. And I'm curious, I think our service areas are already those inland areas where people are sort of migrating towards if they're staying in state. Are you seeing any impacts of those trends on demand?
I think the short answer is yes. I can't really, I think the short answer is yes. I can't, since we're not the direct originator of these loans, I don't really have sort of statistics on how many sort of deals have fallen out because of the direct impact of that. I would say though that when we look at our legacy business, so what we're talking about is that everyone has been watching these forbearance numbers. So when we look at loans that we originated, so let's say in the last 3 years or so, our forbearance numbers are higher than the numbers that you're hearing in sort of the mainstream media. And it speaks to sort of your point, Eileen, that our borrowers are lower income and they tend to be more disproportionately impacted by the pandemic, and their forbearance numbers, because their needs have been tracking higher than these numbers you hear in the mainstream media.
Yeah, if I may just speak a little bit about on this migration. You're spot on. I was just reading a report, I think it was done by U.S. Statistics, that really showed how the sheer number of first-time home buyers, as an example, in 2019 was 41% across the U.S. That number is now down as of April 2020 to 30%. And it also showed that once upon a time, at least for the state of California, folks were moving out of urban areas into less urban areas. So for example, moving out of Los Angeles into the Inland Empire, and now they're just moving out of the state, which is troubling. But that's the burden of having high cost housing in the state of California is watching those migratory patterns that show that our first-time home buyers are leaving. Not in droves yet, but leaving at concerning numbers, because we all know that would ultimately impact first-time, our children, mine as an example, moving out of the state, which is not ideal. We'd love to see those folks stay out for all the obvious reasons. So you're spot on, Eileen, in terms of the concern, and I think that shows in the numbers.
Ms. Gallagher, do you have any follow-up?
No, thank you for that.
All right, great. Mr. Russell.
Yes, thank you. And forgive me if you covered this at the beginning, Tim, of your presentation, but when I'm looking at the increase proposed first mortgage program higher than present year, the current revised, and I I think your response as to what the projection represents is valid. My bigger concern from a budgetary standpoint is the revenue generation. So did you share with us why we went from a 20 million to 63 million revenue generation off of obviously it was a higher volume, but it was 30% higher volume, 3 times the revenue generation, and now we're going to propose an increased lending volume with a lower, a slightly reduced revenue. Could we unpack that a little bit?
Sure. So although these things seem like it happened like a lifetime ago, so during the pandemic, like I would say that sort of summer and fall of last year, when rates were plummeting because of everything that was happening, the loans you generate get packaged into mortgage-backed securities, and these mortgage-backed securities were pricing really, really well, generally, meaning that they were pricing better than we expected on the one hand, and on the other hand, because there was so much desire to chase after rates and yields, because the sort of the treasury notes were such low rates. There was a significant amount, and we speak about this sometimes in the reports, but we tend to not get into this kind of jargon in this forum. There was significant amount of what's referred to as Spec Payup in the mortgage-backed security pools we generate. And in short, what that means is that the prepayment speed behavior of our pools tend to be a little bit slower than the standard pool, and investors are willing to pay more when the pool goes out longer, or rather the prepayment is a little bit slower. So then it's not necessarily something that we typically try to guess what could happen, but this year in the business plan, because this phenomenon you're speaking about, because of this phenomenon, we did try to sort of be more courageous, if you will, that some degree of that sort of outperformance, sort of is the word that sometimes people use in sort of fixed income, sort of outperformance of one class of investments versus another. We were more courageous to project some degree of outperformance in MBSs in the production that we're generating in the coming year. So I hope that gives you some color.
And I think historically we've been conservative in the sense that we don't like to count on a revenue type that can disappear overnight, and and that's sort of historically the case. But we've had a couple of consistent good years with respect to the Spec Payup that Tim just talked about. So we've added it into the equation.
And I mean, just to give additional color on this is that, like for example, since May, as you all know, since April, we're like starting like late March or April, rates sort of backed up significantly. And then right now, if you look at sort of financial media, everyone wants to talk about inflation. So in the current environment, that Spec Payup is actually dwindling and it's quite small. So it's a sort of like a component of the sale of our security that kind of sort of comes and goes. And it's true that in the past years, because of that, we tend to be extremely conservative about projecting as part of our projection. But there's a strong desire for us to sort of, I jokingly say, sort of beat our earnings by a penny, so that we decided to be more courageous to include that in this year's projection. And I don't mean to be facetious, but I think you know what I mean. So there's a desire for us to be closer, even though there's a lot we don't know.
I loved, Mr. Russell, that question. I thought that was really observant. And Mr. Gunning, Chair Gunning, are you ready to jump in and maybe step back? Well, you're not, because you're on mute. You're not ready.
I wanted to see you continue. I was just checking you out. Go ahead.
I was like that spider twirling over a fire, so it was nothing but trouble for me. Mr. Gunning, I'll turn it over to you. I think the next step is for Tim to continue his presentation, and I'll turn it over to you, Chair.
All right, thank you, Preston. Tim, go ahead, brother. Where are you? Number 7?
Yeah, can you go to the next slide, please?
We're still in 5A, so our within that. So sorry.
Okay.
Thanks, Preston.
Can we go to page 8, please? Preston, keep those questions coming though. Here is a historical comparison of the original targets versus what we accomplished throughout 2014. And we started our current single family business model in 2013. And as you can see, over the last 3 or 4 years, it has really taken off. The one thing that I will emphasize on this slide, which is like something I talked about earlier too, is that this is the original target versus actual. Next year, perhaps what we'll do on here is that we'll show original, revised, and also actual. So that, for example, in the year 2019 to 2020, it seems like there's a large gap, but I went back and I looked at our revision, a mid-year revision that year was actually 3.8 billion. So then, if we look at our revision versus our actual, we're a lot closer than what this is showing here. But in any case, what we're showing here is something I already talked about. We did see a decline in production during the COVID, the last 10 months or so, and we're expecting to end right around 2.5 to 2.6 billion dollars. I looked at our April report, and we're very much on target, and this will be the year we beat our earnings by a penny. Next slide, please. We look at the dollars and cents, yes, but as you all know, we care very much about helping every single family get into their first home. The slide here is looking at that human factor in our business. This fiscal year will end up close to about 8,000 plus families that we help to get into their first home. And with our target next year of about $3 billion, that would mean about 9,300 families or so. But as you all know, every family counts. And part of the reason, like if you look at this, one of the things that we talked about already, and you looked at this, some of the numbers, if you try to do quick math in your head, it may not make total sense. It's because the average loan size throughout these years has increased over time. As I mentioned earlier, a couple of years ago, our average loan was probably $310 or so, and if you look farther back in like the 15 or 16 era, our loan size was like didn't breach 300, and now our conventional is 350 and average about 330. So the average loan size has been increasing. So in that way, it has become more expensive to help a homeowner get into their home, meaning that the down payment assistance dollars is also increasing, and also the loan itself is also increasing. Next slide, please. So this is a really good slide to sort of give a visual of what we're talking about when we talk about sort of expanding our product offerings and also focusing on inclusiveness. This is not everything that we offer, but this is sort of the main menu that you'll see at In-N-Out. And we do have other things that's not quite on here, but these are the large sort of things that a lot of people generally talk about. I won't go through every one of them, but I would like to just highlight a little bit of what we've done in some of these categories in the fiscal year. So in this fiscal year, we've done $197 million of school employees. We did 22 loans with fire department employees. We did $196 million of new construction. We did $52 million of manufactured housing. We did 8 loans that had ADUs attached to them. We did 2 leaseholds, and we did 6 VA loans, and we did 11 USDA loans. So it's true that we do have a lot of business in just your average FHA business and Fannie business, but over time we have really made an effort to expand our menu of offerings again, so that we can have more people come into the homeownership tent. And for this year, As I mentioned earlier, we did add that HUD 203H disaster program. And Don also mentioned in the opening remarks that we are going to focus also on the 60 to 80% AMI segment in terms of perhaps providing additional assistance for that population, either out of our own sort of existing resources, or if possible, using these new ARPA dollars that are arriving at CalHFA. So those are my comments for single family. Thank you.
I think we'll turn it over to Kate.
Yes, good morning, Chair Gunning and members of the board. For the record, my name is Kate Ferguson, and I'm the Director of Multifamily Programs. Next slide, please. I'm pleased to be here today to highlight a few of the successes of the 2021 fiscal year and to share a path forward in 21-22. As Don said, we've been guided by 3 primary goals in our business planning process for the next fiscal year, including the expansion of multifamily production and homeownership opportunities, improvements in delivery and organizational efficiencies, and embracing a collaborative posture with our partners and stakeholders to improve development and delivery of effective, inclusive, and innovative housing solutions. This slide reflects our expectations for continuing momentum on the unit production and preservation front. In 21-22, we expect to maintain our 2021 lending volume with a focus on new preservation strategies, including the use of our recycled bond program. Next slide, please. As this slide shows, our overall projections for 21-22 include maintaining our lending at the same level we achieved in 2021. Our fiscal year-end projections reflect a total of $1.87 billion in volume. That's a 78% increase over original projections, which were $1.05 billion. This was driven by the conduit program growth. It was driven largely by the conduit program growth, which is expected to close out the fiscal year at 200% of original projections. The growth was driven in part by the strategic decision to modify our conduit pricing in the late fall of 2020. This made the program much more competitive in the market. While the sheer volume of the growth in the conduit business in the current fiscal year translate to a significant bump in related year-end revenue for conduit to $2.17 million, the 21-22 budget reflects a lower number, more in line with original 2021 revenue growth. Again, that's a reflection of the reduction in pricing for the conduit program that happened about halfway through the current fiscal year. Permanent loan conversions will also be lower in the coming year as the MIP 2019 and 2020 projects continue through their construction periods towards completion. Our permanent loan commitments are expected to remain robust in 21-22, although they will be lower than the current fiscal year, largely as a result of reduced funding for the mixed income program in 2021, sorry. Next slide, please. This slide is a great visual of the successful efforts of the multifamily staff to increase production over the past 2 years. Those efforts, combined with the funding of MIP and the increasingly competitive conduit business, have helped us to keep on the growth trajectory that we started in fiscal year 18-19, which, as you can see, was the first time in several years that the multifamily programs exceeded budgeted goals. The trend continues throughout the current fiscal year. While we are expecting 21-22 to be a year of leveling off in some areas like conduit and perm conversions, we expect growth in our preservation lending strategies and efforts and our recycled bond program to keep us at the same level of production as the current fiscal year. Next slide, please. Most importantly, I want to talk about the unit production that the multifamily team has achieved in the past year. Our revised projections indicate total new production in this fiscal year of 6,071 units. That's a 153% increase over the previous year. The numbers are marginally reduced in the upcoming fiscal year projections to 94% of this year's fiscal year-end expectations. This is a result of the reduced resources of the 2021 MIP program. Our goal is realistic and achievable for next year. My personal challenge will be to once again lead the team the multifamily team to exceed unit production goals to continue our upward trend. In any event, CalHFA can be proud of taking part in the production of more than 13,000 units over the most recent 3 fiscal years. Next slide, please. Let's talk a little bit about the challenges we see for the upcoming fiscal year. We'll continue to see headwinds created by the scarcity of bond cap and the impacts to the need for affordable housing as well as to the cost of affordable housing that resulted from the pandemic. Staying focused on a continuum of need at all affordability levels will also be a challenge. Ensuring that we continue to meet the needs of households in a band of affordability from 30% to 80% AMI. And never without controversy, the cost of development continues to challenge the entire industry, and our ability to manage the soft cost, locality, and state fees will be critical to maintaining efficiency in the use of the resources the state provides for housing. Next slide, please. On a positive note, we're watching closely what happens at the federal level. More specifically, the potential reinstatement of the FFB program, the lowering of the 50% test, and stabilization of CRA will all result in improved stability and access to resources for development in the state of California. Closer to home, the CalHFA Recycle Bond Program continues to gain traction as an augmentation to the existing resources available for new construction and preservation in the state. We're pleased to have been a part of the collaboration in 2020, which resulted in a revised regulatory structure for CIDLAC. While cleanup and refinement of this structure continues to happen, having the permanent structure in place has led to a more efficient and predictable environment in 2021. And finally, under the guidance of Secretary Castro Ramirez, who I'm sorry she's not here today, a concerted effort to create and work within a collaborative environment among all state agencies will facilitate improved coordination and focus on administration values and priorities. Next slide, please.
Hey, Kate, can I ask a question there?
Yes, sir.
Just the stabilization of CRA, I know they're making changes, but would you just expand upon that? You do mean the Community Reinvestment Act, correct?
I do, and I think generally in the what we're hearing just sort of chatter in the industry is that there are not, I think with the last administration in Washington, there was the risk of major change to that that legislation, which of course drives the investment market for low-income housing tax credits across the country. What we're seeing now is that the trajectory for those changes has slowed. We're very hopeful that the CRA, the Community Reinvestment Act, will continue to stabilize so that our investments will continue to stabilize and hopefully increase in value over the next year.
Good. That's what I thought you meant. I wanted to make sure.
Yes, that was. Thank you for gunning. Okay, so continued priorities for 2021. Our priorities will continue to mirror the 3 primary goals we talked about in the business plan, including deployment of our programs with a focus on readiness and efficient use of resources. Our operational efficiencies continue to be a priority in our efforts, and the new multifamily systems platform is expected to go live in late summer, which will improve our overall internal coordination between the management of our assets as well as the lending platforms. Finally, our commitment to collaborating with our partners and stakeholders will remain paramount to ensuring our programs are relevant to meeting current housing needs in the state and to make sure that we are in a collaborative and partnership environment with our state partners. So with that, I'd be happy to take any questions, or I can turn it back to Tim.
Chair Gunning, this is Delilah Sotelo. I had a question.
Go ahead, Delilah.
Okay, thank you very much for the presentation. It's extremely helpful. Do you have information about how much of the market share we have presently? How many of our applications went through in the last 2 or the last 3 CIDLAC funding rounds?
I don't have that
compared to the total?
I don't have that off the top of my head. I'm happy to provide that to the board after the fact. I can tell you that I'm going to do a quick summary of this year's mixed income program, and we'll be submitting those deals to CIDLAC in the next round. Our conduit business continues to be robust. I just don't have the exact numbers, so I would be happy to provide that for you after the board meeting.
Okay, thank you. I think that would be a nice metric to keep tabs with.
Absolutely.
I would just add really quick, if I might, that I guess for a quick frame of reference, our revised target for this year is 1.5 roughly of conduit issuance. So I would assume that if you took that against the amount of bond cap that's been offered, that would give you some context of the applications that we put through CIDLAC and what's been awarded.
Okay, great. Yeah, because the what's been awarded is also an important element.
Well, and to that point, the total bond cap for this year at CIDLAC is 3.7 billion. So that would indicate that we would be getting hopefully somewhere close to a third of that. I see Treasurer Ma's hand. Sorry.
Thank you.
Thank you. Thank you, Kate. The bond cap for this year was 4.3 billion, but everything but 600 million is going to housing.
Right.
There is the priority of the governor, and he's been very generous in allocating 500 million in state low-income housing tax credits. This is for the third year in a row, which makes our bonds at CIDLAC very, very competitive. We also have another round of disaster credits. That's 9% disaster credits that we are going to be rolling out, and we have issued initial regulations on that process if anybody wants to weigh in. But housing is a priority, and I just do want to reiterate what Ms. Ferguson said, is that the four agencies are working collaboratively together. Last year in 2020, even during the pandemic, we approved more housing units than ever before in history. And that is because, you know, the governor and myself, as well as Secretary Castro Ramirez and Gustavo Velazquez, as well as CalHFA, we are all very committed to do what we can to make our processes more efficient, more effective, more transparent. For the first time, we've had a joint application for CIDLAC and TCAC. That's the first time in history. And we last year rolled out a joint application with CalHFA. And I know that HCD is working very hard under AB 434 mandates to align their 6 funding sources so that applicants can go to HCD and go once and get allocated 1 or up to 6 different funding sources, and then with that guarantee piece of paper can come to CIDLAC and TCAC instead of the way it works now. There's different timelines and funding sources, and so applicants who are utilizing HCD funds, take a long time because of trying to put this puzzle together. So stay tuned. I think the Supernova for HCD is going to come out February 2022 is my understanding, working with Mr. Velazquez and his team. They're doing great work. And again, everybody is really aligning together. However, we have a bond capacity issue. And so we are working also with our federal partners to try to, increase that cap, also change the basis from basis requirements from 50% to 25%, which would allow more projects to apply for bond caps. And then also obviously the recycling of bonds, and then also thinking and trying to work with other states who are not using their tax credits and bonds, whether we can have some sort of mechanisms where we can share, buy, exchange or something so that we can get more tax credits and bonds here to the state of California. So all that is in the works, and I thank CalHFA for being a great partner and also one of the voting members on TCAC as well.
And thank you for that, Treasurer Ma. And you're right, I did misspeak. The 3.7 billion is what is allocated to housing out of the total bond cap for the state this year. And our 1.5 billion expectation for conduit also includes recycled bonds. So I would expect that our somewhere between $1 billion and $1.2 billion will be what new bond cap conduit issuance will be submitting to CDLAC this year. So thank you for that. Any other questions?
That was fascinating. Thank you, Treasurer Ma, and everyone. That was really great.
Okay, we'll hand it back over to Tim.
Sure. Okay. So for somebody, board members, you know that we have been on a path of restructuring our balance sheet for quite some time to strengthen our balance sheet, and so to restore our credit rating to what it was before, not this crisis, but before the last crisis. So our goal has been to restore our rating to the AA range, and we have done that. Our goal is to really get to AA minus, AA flat. And in the last couple of months, Moody's has now taken our, when we say our rating, we're talking about our issuer credit rating or our general obligation rating. So our general obligation rating was finally brought to the equivalent of AA minus by Moody's earlier this year. So we now have sort of the same rating in terms of our general obligation from both S&P and Moody's. And our goal is to take us to AA flat versus AA minus. So we're getting close. And as mentioned by Kate earlier, we also have a recycling program that is very successful that we hope to sort of scale up. We are working on a couple of large transactions that can use a recycling volume cap. And I think that barring sort of significant changes in the tax code, which I know Treasurer Ma spoke about, the recycling program could be extremely helpful for example, for 80/20 transactions. LIBOR migration, this is something that a lot of people are looking at, albeit for quite some time there has not been any changes to the promulgation of the rules and regulations, but this is something that needs to get done by the end of the year. We do still have some amount of what I refer to as orphan swaps, fixed rate pair swaps that are no longer hedging variable rate bonds. We use them as a balance sheet hedge to hedge our loan commitments on our balance sheet, but some of them are LIBOR based, and we do have to migrate them out of LIBOR by the end of the year. And the last item on here, which is to eliminate all the variable rate bonds, I'm both sort of relieved and sort of happy to report to you that next month we're going to get rid of all the variable rate bonds that we have on our balance sheet. So I know, I'm not sure if Jonathan's here. I finally decided that, you know what, after a couple of board meetings of a drought of not talking about sports, I decided to create all sorts of weird sports comparisons that I could dream of. So we started this journey of our variable rate bonds being a problem in my balance sheet in October of 2008. One would say many lifetimes ago. So for October 2008, in October 2008, when we got our very first what's referred to as a bank bond out of our variable rate bonds. And in January of 2010 is when we layer on what's referred to as the TCLP, or temporary credit facility from U.S. Treasury that basically, in retrospect, we can be a bit more transparent, that basically prevented us from becoming insolvent. So from October 2008 to June of 2021, it was 152 months of this journey of getting rid of all the variable rate bonds. So I looked up what was the longest baseball game. It was merely 8 hours and 6 minutes between the Chicago White Sox and the Milwaukee Brewers. And I looked up the longest cricket game, and it was only 9 days. After 9 days, they couldn't get a winner, and they stopped. But here, we did not stop. We finished our journey. And Magellan, apparently, in the 1500s, took 3 years to circumnavigate the world. Anyway.
That's hilarious.
After 152 months, we're finally going to get rid of all our variable rate bonds on our balance sheet. There is a small piece of auction securities that's going to get called in the middle of next month, and there's about a $20 million variable rate bonds, VRDO, that's going to get called in the middle of next month as well. So that at the end of the fiscal year, for the next audit, we won't have any more variable rate bonds. So that's my comments and answers.
Hey, Tim, that's just awesome. Thank you, thank you, thank you. And great delivery. But don't quit your day job.
Yeah, Johnny, we have to pause for a praise break right there. That's
right,
phenomenal.
right. Thank you. It's unfortunate Jonathan's not here because I know he'd say something. So on behalf of Jonathan, well done, staff. Well done, Tim. That's just incredible.
Yeah.
Yeah, it's been a very, very long journey, and I think that it's finally the end. So I have to dream about something else with Jonathan for the next board meeting.
So I don't know if you want to advance the next couple of slides. They just reflect our current historical credit ratings, and they're headed. And I think haven't we actually surpassed in at least one area where we were pre-financial crisis, or have we just achieved where we were?
Yeah, the only really, truly the only credit rating that matters anymore for CalHFA, in short, is our general obligation rating, or our issuer credit rating, because the flagship indentures that we have, like HMRB, which is our single family, and multifamily 3, which is our multifamily, they have shrunk tremendously because of all the efforts of getting rid of the variable rate bonds. So while it is true they're still there, my sort of projection, which no one should go out there and start trading on this, my projection is that most of those bonds will be redeemed out in the next 2 or 3 years because of the prepayments that are coming in, and because of the if you look at the financials for these indentures, they're highly over collateralized. There's a lot more cash and assets than there are bonds. So they're going to, it's just the natural course of what's happening there with prepayments. The bonds will get redeemed, and those indentures will come to a closure, in the next couple of years. I don't know when, but if you just look at the balance sheet, it tells you that.
Okay, can we advance the slide? There we go. So moving on, under strategic planning goal number 2, CalHFA has long adopted a philosophy here with our management team of what we call continuous self-assessment, in which we try to apply it to all areas of our operations. And basically what I mean by that is that we routinely challenge ourselves in terms of what we're doing, how we're doing it, and what we can do to improve the results and the experience for our clients. Some key initiatives that we identified for the next business planning cycle is, 1, to expand the use of our data visualization and mapping tools like GIS and Power BI to improve, excuse me, our internal and external reporting, as well as the public-facing platforms like our website and social media, so that we can help tell our story better visually to the various stakeholders that we serve. Another initiative is our e-signature project, which will assist CalHFA in streamlining our workflow for documents that currently require manual signatures. This project is going to do 2 things. 1, it satisfies a DGS directive to state agencies that we need to enable all of the standard state documents to be able to be signed electronically. But we're taking that initiative further in that we're going to try to utilize it to deal with all the documents that flow through our business so that we can expedite the processing time on documents, cut costs related to the print costs to print stuff and route it around, and also just to improve the service levels for both internal and external customers. Next, we intend to finish the final phase of a multi-year effort that Kate mentioned in her presentation to fully transition our multifamily loan origination and asset management activities into a single system platform. Currently, multifamily, both origination and asset management, have used like two different system platforms, as well as Excel and other documents outside of the systems that have led to very difficult issues related to reporting and just dealing with things from an internal management perspective. And so for years, we've been trying to identify a system that we could migrate all these activities to. And we identified that last year, I think last year, and we've been working with a programming consultant to help us engineer it to work for both asset management and origination. And by the end of the calendar year, we expect it to be fully operational for both sides of the business, and we think it's going to yield great benefits to us in terms of efficiency. In addition, we plan to perform other system upgrades throughout our technology infrastructure to update the functionality and make sure that things are working optimally, including ongoing efforts that we started a couple of years ago to move more and more of our system applications to the cloud. Finally, we're going to file the updated state leadership accountability reports, which will be due next fiscal year as well. And that basically is an organizational assessment tool that is used to identify risks that threaten the major activities or goals of the organization, objectives of the organization, and ensures that we have either the appropriate or to a corrective action plan. Are there any questions around that? Okay, next slide, please. Regarding collaboration and partnerships under Goal 3, we're going to continue to work in partnership with federal, state, and local agencies on a variety of programmatic initiatives, from home ownership, bond recycling, homelessness, mortgage relief, housing counseling, accessory dwelling units, just to name a few that you've heard through the course of the presentation. Additionally, we will continue to provide technical assistance to the governor's office, the legislature, BCSH, CIDLAC, and TCAC on housing-related matters. And with respect to affirmatively furthering fair housing, we're excited to see our first cohort of CalHFA staff. I think we have 16 people going through a training, 14-month training program with the Capital Collaborative on Racial Equity. And that we're going to, hopefully in this next fiscal year, the goal is to implement the agency's first ever racial equity action plan. Additionally, we plan to expand our outreach efforts to socially disadvantaged communities through our programs to improve awareness and access to CalHFA resources and to help break down the barriers that have prevented the creation of generational wealth. Next slide.
Just real quick, can you just distribute like who facilitated the C-Corps work? And I would love to see that, love to think about how to bring that to Santa Clara.
Yeah, absolutely. And one of our tactics for CalHFA's purposes was that we selected folks from every division in the organization with the intention of getting them trained, getting an equity action plan put in place, and then also have those individuals serve as sort of ambassadors throughout the organization. And I'm imagining that at some point we'll have another cohort go through as well. But yeah, we'll be happy to distribute that. And then that concludes the overview of the proposed business plan for 21-22. Are there any questions before I move on to the agency's proposed operating budget?
Questions from board members?
I have one.
Sure.
Go for it.
Hi. Can you hear me okay?
Thumbs
Yes,
up?
you're good, Melinda.
Wonderful. Wonderful. Hi, Undersecretary Grant here on behalf of Secretary Castro Ramirez. Just wanted to commend the board and the agency for really well put together business plan. I know that the executive director in the past has been very involved in racial equity, had participated on the California Leads as an employer, race, ethnicity, and gender group. And so a lot of work has been done in that space, and just wanted to also just say kudos to your goal number 3 on the collaboration piece. I think in light of coming out of the pandemic and everything that we're all going through, whether it's our neighbors or our family members or who have you, right? There's a lot of resources out there where folks are trying to figure out how to get to them. And so I think we're stronger together. And thank you, Treasurer Ma, for her comments earlier. I think it's very complimentary of this collaborative goal 3. And so job well done. We stand ready to assist and serve.
Awesome.
Yeah, if I can just say quickly, because I completely agree. This is really exciting. Equity and inclusion is at the top of the list. We, whether it's the political kind of turmoil, rightfully so, happening over the murdering of people of color, particularly Black people, but also the disparities that COVID has shown. Racial equity, inclusion has to be at the top of our work. And so I'm just really glad to see it's happening, not just at C-Corps, but it's happening within CalHFA in our programs, and we're being intentional. Tina, I know you've been talking about Black wealth for a long time. This is like, I'm really glad it's at the forefront of our thinking as well. So I know that there's been a lot of work happening, but it's just exciting, again, that this is the stuff that we are doing.
Great. So moving on to the CalHFA operating budget for 2021. With the business plan and its goals as our guide rail, the leadership at CalHFA was tasked with going back and building budgets designed to support the implementation of the business plan. The following charts summarize the estimated resources for fiscal year 21-22 and how they will be deployed. Agency resources are primarily generated from loan origination fees, interest income on loans, loan servicing fees, and compliance monitoring fees. Unlike 5 years ago, revenues generated from current lending activities now cover the entire operating budget twofold. For fiscal year 21-22, operating revenues are expected to be nearly 90 million. Next slide, please. As you can see from this chart, we are recommending adoption of an operating budget of basically 39 million, of which 25.8 million will be used for personal services, which is your salaries and benefits. And then 13.2 million will be operating expenses and equipment. Resources for the fiscal year are expected to exceed operating costs by about $50 million and will be used as capital reserves to support debt management efforts like the ones Tim has been describing earlier, and lending activities and future operational costs of the agency. Next slide, please. The proposed operating budget reflects a $683,000 or 2% decrease in appropriations compared to the prior year, and is directly attributable to anticipated reductions in consulting and professional services costs. Other than that, the proposed budget is almost a mirror image of last year in many respects. Next slide. For fiscal year 21-22, the agency is proposing that authorized full-time equivalent positions, or FTEs we call them, remain relatively unchanged at about 223.6 positions, 221 permanent positions and 2.6 temporary and or limited term positions. We continuously work with our management team to determine future staffing needs, and we are cognizant of the need to attract, develop, and retain staff to deliver on organizational goals and facilitate succession planning for the future of CalHFA. Our proposed staffing levels are basically status quo with last year's proposal, and the agency is actively recruiting for several open vacancies throughout the organization. Additionally, I'd like to note for the board that we have 3 candidates for long-term executive level vacancies being vetted for appointment by the governor's office, and we are very hopeful about the outcome of that process. The executive team here has been spread pretty thin over the last couple of years, and we could use the additional support and capacity to help with all of our new initiatives and maintain the performance standards that the agency has come accustomed to. So next slide, please. That concludes my overview of the operating budget, and staff is requesting board approval of the strategic business plan and operating budget, and we are available for any additional questions the board may have.
Chair Gunning, I don't know, do you need a resolution or a motion for 2109 and 2010 separately, or can I do them together? I think they're
we need two, don't we?
They're posted separately.
We prefer two separate votes, but Chairperson, if you prefer to combine them, that is within your authority to do so, sir.
I will follow the rules. It's really hard for me, but I will make a motion, Chair Gunning, to adopt Resolution 2109, the strategic business plan.
Thank you, Preston.
This Anna Marie.
Thank you, Anna Marie. It's a motion and a second. Melissa, roll call, please.
Anna Marie Avila Frias,
Yes.
Ms. Gallagher,
Yes.
Ms. Gunn. Ms. Gunn, I'm not hearing you. Mr. Gunning,
Yes.
Mr. Hunter is absent. Ms. Johnson Hall,
Yes.
Treasurer Ma. Is Mr. Starr sitting in?
Yes. Yes, for the treasurer.
Thank you. Mr. Seeley,
Yes.
Ms. Grant,
Yes.
Mr. Prince,
Emphatic, yes.
Mr. Russell,
Aye.
Ms. Sotelo,
Yes.
Mr. White.
Yes.
Chairman, Resolution 21-09 is approved.
Awesome. Thank you. Preston?
I was trying to be polite, but I would love to make the motion for the adoption of the proposed operating budget for fiscal year 2021 to 2022.
Thank you. Is there a second?
Second.
Mr.
Stephen Russell.
Second. Thank you. There's been a motion and a second. Melissa, roll call, please.
Ms. Avila Frias,
Yes.
Ms. Gallagher. Ms. Gallagher, I'm not hearing you.
Yes.
Thank you. Ms. Gunn? Not hearing Ms. Gunn. Mr. Gunning?
Yes.
Mr. Hunter is absent. Ms. Johnson Hall?
Yes.
Mr. Starr?
Yes, for the treasurer.
Mr. Seeley?
Yes.
Ms. Grant?
Yes.
Mr. Prince?
Aye.
Mr. Russell?
Aye.
Ms. Sotelo?
Yes.
Mr. White?
Yes.
Chairman, Resolution 21-10 is approved.
Awesome. Thank you, everyone. Don, are we on item 6?
We are, and before we move on, I just wanted to take a second and thank the board for their support. A lot of work goes into the preparation of the business plan and the budget, and I just want to also give thanks to the staff and the team here. They put in a lot of hours and a lot of time, and I just want to recognize them for that. Thank you.
Thanks, Don. Tim, you gonna go? Item number 6.
Sure.
Looks like you've been here before. Go ahead.
Yes, and it's a good story. I think, how should I say? Yes, it's true that we've been through this before, but I like to think that we're part of the happy ending. So what we're talking about is that, as alluded to earlier today, in the American Rescue Plan, ARPA, there's almost $10 billion allocated for a homeowner assistance fund. And California is slated to get a little bit more than $1 billion of that $10 billion. And what Chairman Gunning and I are talking about is that many of you know that we did run a very, very successful program out of the last financial crisis, oftentimes referred to as the hardest hit funds. So for the hardest hit funds, we got a little bit more than $2 billion to do a homeowner assistance program. And that program actually wound down May of last year in its entirety. Board members, sort of Tina Johnson Hall and Delilah are also on the board of that nonprofit that administered that program, which wound down last year. So this is something that we have done before, and we had an extremely successful program last go around, which we had reported to the board many times during the history of the program. So this is in some sense, it's the same crisis that we're experiencing, but there are a lot of things that are different. Sort of like we talk about sort of this idea that history doesn't really repeat, but it kind of rhymes. It has that kind of same sense about it. Last go around, as the board members know, it was much more of a equity issue. It was sort of equity, not in the sense we use it today, as in like racial equity. We're talking about sort of equity in people's homes. It was much more of an equity issue, and the issue we're talking about now in terms of affordability, for reasons that are beyond my comprehension, prices in the last 12, 15 months in terms of single-family real estate, especially in California, has gone up a lot. So the crisis that we're addressing are different in its sort of financial nature, but it's still an issue of homeowners requiring assistance. So I'd like to sort of go through a little bit of what we have done so far, what this resolution is intending to ask from the board to consider, and also a little bit about sort of what we've been thinking about so far in terms of the program. So on April 20th, we did file an intent of receiving the dollars to run a program. That was a requirement that they had, that meaning that you had to submit an intent that you want to receive the money to run the program. And later today, I believe our esteemed colleagues in our legal department are going to work with Don to submit the next thing, which is to submit a financial agreement to Treasury so that you can receive 10% of your allocated amount, so you can start using that dollars to prepare a team, build a system, build an infrastructure so you can run this program. And then by the end of June 30th, 2021, you need to submit a plan on what you intend to do, what kind of programs you want to run to create a homeowner assistance program in the state of California. And I believe that we're expected to get an approval for that plan by the end of July. And then that's sort of the process we have to continue to go through with Treasury. In terms of this resolution, what this resolution is asking from the board is the ability to execute all the agreements that we need to do with the U.S. Treasury. As I alluded to, that we have submitted a notice of intent that was sort of really quick, so that we did submit a notice of intent for the state of California. There's a financial agreement that we're doing later today, and then there's a plan, and later there's just this host of agreements that we might have to enter into U.S. Treasury, amendments to the plan. It's requesting for that. It's requesting for the ability to enter into all the requisite contracts in order to administer the program, build a system, build infrastructure. Last go around, board members might recall that we create a nonprofit to receive the dollars to run the program. That has a lot of benefits that we would like to sort of repeat that structure as well. So the ability to create a nonprofit to administer the program. And last but not least, since we just passed the budget for this coming fiscal year, there's an item that is asking for the board that should CalHFA enter into contracts that is for the sole purpose of administering those funds, these funds, the HAF funds, and CalHFA will get reimbursed from the administrative costs of HAF. Again, to the extent that we enter into these contracts and we get reimbursed out of this program. We'd like the board to not consider those contracts as part of our budget. Otherwise, we would have to, keep coming back to the board to increase the budget to accommodate that piece of it. And in a nutshell, that's what the resolution is requesting. Just a few words, and I'll take questions about what we're thinking about so far in terms of the program. The lead time to launch this program is not the same as the lead time that we had last go around. There is an effort from Treasury to alleviate many of the requirements that we had last go around, because there's a sense of urgency and getting it off the ground. So last go around, we have 4 programs, and I won't go into all of them, but we had significant lessons learned from each of them. And the one that we felt that was the most effective and perhaps fastest to stand up is what's referred to as a mortgage reinstatement program, or sometimes we call it MRAP. That program is a program that was specifically called out by the guidance from Treasury, and is a program that even before this, shout out from Treasury, we had thought that this would probably be the best program to run. So then we are thinking about a mortgage reinstatement program to alleviate the arrearages that comes from all the forbearance that people are enduring or experiencing. And in a nutshell, that's sort of like the centerpiece right now of what we're thinking about in terms of the program. So I'll pause for any questions from board members.
Chair Gunning, this is Delilah.
Yeah, Delilah, go ahead.
Tim, what's the volume that you anticipate seeing in these programs? The dollar volume.
Well, we're receiving just a little bit more than $1 billion. And right now we're handicapping that we would do about $50,000 per household or per assistant. So that could amount to something like 20,000 households, give or take.
And tell me again what your rationale is for not putting this under the purview of the board for oversight. To the budget.
I'll do my best to answer that, but perhaps Don and Claire could also chime in. There is a desire to keep the over time, those funds, when used, to create a trail of history that, as you know, is subject to federal investigators that come along to investigate cases. There's a strong desire to keep the finance ins and outs of that in a completely separate entity that's subject to a completely separate audit, versus intermingling it with CalHFA's sort of funds. And then for me, I feel that that's a very strong benefit of keeping it separate. But as you know, the composition of that board over time, the old nonprofit that is, does have a significant overlap with the composition of this board, and we can do that again. But keeping sort of the ins and outs of that money separate from the ins and outs of CalHFA's money, which is already, as you know, complicated by sort of funds that we administer for the state as well. That for me is a strong motivation. But I like Don and Claire to chime in as well.
Yeah, I think that Timmy did a nice job articulating that. I think part of the motivation is, we have gone down this road previously, and it was very successful in terms of its structure. And I think the desire to sort of wall off the federal clawbacks that our balance sheet would be exposed to if we don't sort of create this sort of autonomous entity to sort of administer it. But I hear the concern in your voice about oversight, and I think Tim made a good point, which is that there will be a board for this nonprofit. We do have board members that participate on that board, as well as staff, and our staff. Tim specifically will be the president of that entity. So there will be oversight and at some level by this board and by the staff at CalHFA as well.
Yeah, I think it wasn't clear through the presentation that nonprofit would continue. My understanding was that we were, in essence, dissolving that. But if that is going to continue and that interface will remain at the board level, I think that would be, I think that would be good. I mean, the way we successfully deployed the funds under that, previous administration previous program, it worked really well. I just think that there needs to be oversight, and there needs to be a checks and balance in it. And whether we see that at the audit committee or whether we see that at the full board meeting through a formal report back to the board, I think it's important to keep those two. So if I were to support this, to me, it would be contingent upon continuing and activating representation on the nonprofit board of directors as part of the action to allow for this separation.
Yeah,
I think,
sorry.
I think the idea is to create a new one, though, right?
Yes.
Yeah,
But with the functionality, I think, Delilah.
Mm-hmm. Yes.
Right.
So I know I didn't cover this, and I apologize, that the old nonprofit that administered the hardest hit dollars is still around. Many of you know that though the program has wound down, the program is subject to a trailing 3-year audit by SIGTARP.
Right.
So it is like, as we speak today, we are dealing with SIGTARP on some cases. And that will continue, and the entity will continue, although it's not very active, right? We're not doing any new cases, we're not funding, but we're simply dealing with the administrative audit, a trailing administrative audit from SIGTARP. What we're trying to do here is to keep all that separate from these new activities, and to your point, also from the activities of CalHFA, so they could all be separated out and keep it a little bit more separate and distinct in terms of the ins and outs of the funds, the files accretion, the storage of the files, etc. So a new profit will be, the idea is a new profit will be created to administer this program, and a new board of directors for that nonprofit would also be chosen to provide oversight for the nonprofit and the program.
And I think if you would, I would just say that our intent is to, structure something that is not probably exactly identical, but the importance of transparency and oversight is something that's forefront of mind for us. And the same kind of transparency you had with the old program is what we would be striving to have for this program as well.
Let me just understand the resolution that you're asking for today, or the authority that you're asking for today. How does that relate to the structuring of the nonprofit in the future?
It just gives us authority to set up the nonprofit, and then we would set up the board along with that process.
Okay, but it's not allocating the authority. Is it making a contingent? And maybe this is a question for Claire, but is the authority to run the program separately, contingent upon the ability to set up the nonprofit and to have oversight, by members of this board? Or is that two separate actions?
I'm sorry, Ms. Sotelo, I don't completely understand the question. Can I ask you to say it again?
Sure. I'm just trying to figure out if what we're being asked to do today is authorize the program and authorize the program outside of our oversight so that it's just, handled by staff by itself, or are we being asked to then, to authorize this and have it be contingent upon setting up the new nonprofit and having the board oversight on that new nonprofit entity? Or is that action going to come back later?
I'm sorry, I am still struggling to completely understand.
No, I think I have it. I think I have it, Claire. And I think, Delilah, no, it's not specific in terms of oversight. The resolution authorizes staff to move forward with one, accepting the funds from Treasury and then establishing the nonprofit. You could be correct. We may need additional language that would do the oversight you're requesting now.
The reso does say to create a nonprofit entity if it's deemed useful and governing board of directors to administer that entity.
Right, but I think what's operative in terms of what my particular concern is, and maybe other board members don't share this, is that we have the ability as board members to have representation on that board, so that there is an ability to create, oversight and accountability.
Is that the intent, Don?
Yes, that is the intent, and I would be happy to see if Claire could suggest some language that could amend the resolution to say create a nonprofit entity and governing board of directors to administer the program, including representation from the CalHFA board of directors, something to that effect.
So I'm happy to amend the resolution with that exact language right now, Mr. Kabir, if that is what the board would like.
Delilah, is that satisfactory to you? Or you want to see us?
I think so. I mean, no, I think that accomplishes what we're trying to achieve. I just don't want this billion-dollar program to live in isolation without a checks and balance from the board.
Yeah, and I think I share your concern, and I think the goal here is to replicate what you did before with Keep Your Home. So
right.
My appreciation is that, yes, you or Tina or someone from the board would be part of that nonprofit, and we'd have updates just like we did with Keep Your Home.
Yeah, and then we would have the ability to bring that to the audit committee as a report back or something like that for performance purposes.
It didn't go to the audit committee before, Chair. I'm feeling you, Delilah. I got you.
I'm feeling my chair.
Power base.
Hey,
that's a good question.
The president can do it. No, I'm kidding.
Very good concern. I agree.
So, Mr. Gunning, if I added additional language to the existing resolution that said the following, in the event one is useful or necessary, create a nonprofit entity and governing board of directors, including representation from the existing CalHFA board of directors to administer MAP, would that be acceptable?
Throw in and report to the board.
Yeah. And then Chair Gunning, if necessary, I think I'm saying that it is necessary to have that nonprofit board of directors oversee the program.
I don't think she meant if necessary. I think it is. We're saying that, Claire. So not if necessary, we're saying yes.
Well, I think the language, if necessary, was intent on if there could be a possibility that Treasury says we can't use a nonprofit. We're still in that process of application and plan with them. So the if necessary wasn't meant related to the things we're talking about. It was meant to whether or not it's necessary to set up a nonprofit. So
depending upon how they give you the money, yeah.
Right, and Chair Gunning, my thinking on this is that you don't want to put too many too much brick and mortar on this resolution because, as Don mentioned, this still has to go through several layers of approval. So I think keeping it more, understanding your concerns, Delilah, but still keeping it as flexible as we need it to be so that we can get through the process and get the money over to us would be the first step of this. And then if we, and I'm recommending that if Claire or Don, as they receive additional brick and mortar or direction on this from the treasurer's office, that they come back to the board and ask for those things in light of the lens that board member Delilah shared.
Okay. I get that. Delilah, you follow?
Absolutely. I totally agree with that. Thank you very much.
Good. So, Claire, I think we will adopt that language.
Okay.
Any other questions from board members?
I have a quick question regarding the remaining 90%. How quickly is that turned over to the team, to the agency?
Once Treasury receives our plan, that gets submitted, I believe June 30th, and Tim, correct me if I'm wrong, after that plan is approved, we are eligible for the 90%.
Thanks.
Any additional questions? Is there a motion for resolution 2111?
I'll move that
I
we
move to
approve.
adopt.
Oh, go ahead.
That's okay. Go ahead.
This is Anna Marie. I move that we approve resolution 21-11.
Is there a second?
That motion. I'll second.
Thank you. There's a motion and a second. Melissa, roll call, please.
Okay, and Chairman, I just want to confirm that that's resolution 21-11 with revisions as noted in the motion.
Yes.
Okay. So, Ms. Avila Farias?
Yes.
Come in.
Ms. Gallagher?
Yes.
Ms. Gunn? Still not hearing Ms. Gunn. Mr. Gunning?
Yes.
Mr. Hunter is absent. Ms. Johnson Hall?
Yes.
Mr. Starr?
Yes, for the treasurer.
Mr. Seeley?
Yes.
Ms. Grant?
Yes.
Mr. Prince?
Yes.
Mr. Russell?
Aye.
Ms. Sotelo?
Yes.
Mr. White?
Yes.
Chairman, resolution 20-11 with revisions as noted is approved.
Awesome. Thank you, Delilah. Thank you, board.
Thank you.
All right. Mixed income program update. Item number 7.
Yes, Chair Gunning. Again, good morning. Lunchtime now, board members. So we will try to be very quick in the next 2 reports out. I did want to, given that we're through our initial commitment phase for the 2021 mixed income program, I thought it's a good time to give you I will be brief, but a brief overview of where the program stands. Next slide, please. So this is just a quick look back at 2020. All loans have closed their construction loans and are in construction right now. I've listed here some of the outcomes related to the 2020 program. As you remember, we had over 100,000 a unit in cost savings. We lowered our execution commitment to close to 14.8 months. We created 3,229 units with an average AMI of 60%. That was 20 projects. And we also, just to say it again, received the 2020 NCSHA Outstanding Program Award for rental housing. Next slide, please. So the funding and structure of the 2021 MIP were presented to the board at the January board meeting. As you know, this is an over-the-counter program with applications being reviewed as received. We closed applications in March after having received 44 applications in total. 42 of those met all of the program guidelines and threshold requirements. CalHFA then ranked the applications using the methodology defined in the CIDLAC regs, which included a statewide basis limit delta to adjust for geographic cost differences. All of that was clearly outlined in the term sheet. Our final ranking was based on the project per bedroom efficiency in terms of the use of mixed income funds and state tax credits. MIP funds were sufficient to provide commitments on 13 shovel-ready projects, which include 1,938 units, and an average affordability over all of those projects came out a little bit lower this year, which was interesting, at 57% AMI. These 13 projects will also utilize $360 million in CalHFA permanent loan debt and $544 million in bond cap under CalHFA's conduit issuance program. CalHFA will submit applications to CIDLAC later this month for the second round of allocations in accordance with the MIP term sheet and the individual commitments that have been provided on the projects to the developers, and based on the delegated authority of the program provided to us by the board. That's just a very brief look at where we are with this. We're really hopeful. Everything depends on whether or not they compete well at CIDLAC and get the bond allocation, but we have 13 very strong projects that are shovel ready, and we're hopeful that we can also get these closed on their construction financing by year end, calendar year end. So with that, I'll take any questions. Very brief update, as I said.
Questions from board members? Thanks, Kate.
Yes, sir.
Mr. Gallagher.
All right. Well, I guess I get to be the first to actually wish everybody good afternoon. So it's 12 o'clock. So Chair Gunning, members of the board, thank you for having me today. And I should also start by apologizing for wearing a striped shirt. I should know better on these. I assure you it's not as exciting as it looks on your screen in person. I just wanted to spend a few minutes to give you a high-level update about the Special Needs Housing Program. As I believe most of you are aware, that program was set up as a transition between the Mental Health Services Act program and HCD's No Place Like Home program. We are well underway with the wind down of that program. So just as a quick reminder to everybody, local governments were able to roll over their unused MHSA dollars or deposit additional local funds into their SNP accounts. And that financing could be used for permanent supportive rental housing with dedicated units for individuals with serious mental illness and their families who are at risk of homelessness or who are already homeless. So just to go over a few of the quick milestones that we have, and what you see on your screen is the package, it's what's in your package. The application deadline for SNP was January 3rd of 2020, which means we've known the entire universe of the SNP projects for some time now. There are 55 total projects that are either in the pipeline for approval or already in the portfolio. The deadline for construction close on those projects is June 30th, 2022. And I just wanted to make sure the board knew that all projects are currently on target to close by that deadline. In fact, our latest project, our latest closing for any SNP project is March of 2022. So we have a few months buffer there, but everything looks like it's on target as of where we're at now. We are actually working on a letter right now that will go out to all the developers as well as the local government contacts to remind them of that deadline. So that'll be going out soon. It'll give them about a year reminder. We are also working to return the unused funds with the county contacts that we have. So the way that the SNP funds work is the counties were able to elect whether they wanted the funds returned to them or if they wanted those funds applied to existing project capitalized operating subsidy reserves. So based on what the county elected, we either apply those funds or return them to the county. And so we only have 4 counties left in terms of funds that we have to get back to them. We've already got it back to all the other existing counties, and those 4 counties, it's in process right now. So there's some charts, and I know you can see one on your screen there. There's some charts that are included in the board package to show you the SNP funding production during each fiscal year since we've been doing the program, the project status for all 55 of those SNP projects, and the breakdown of the projects across the participating counties. But just in sum, we are expecting by the time it's all said and done to do 121.3 million across all 55 projects in terms of lending volume. And over 86 million of that was already closed as of March 31st, 2021. So we are already over 71% of the way done with all those loans. And I can tell you that since the end of March, we've closed a couple additional projects, and that number is now up over 90 million. So we're on track. I just want to mention briefly our compliance monitoring. Per the terms of the participation agreements, CalHFA performs ongoing compliance monitoring during the term of the loan, and we do get a servicing fee for those efforts. Since HCD launched their No Place Like Home program, we have seen some projects, there's actually 15 of the SNP projects that list both SNP and No Place Like Home as a source of funds. So in an attempt to save these projects some ongoing costs and to reduce the duplication of efforts between us and HCD, we're exploring options with HCD to transfer those 15 to HCD once they close, so we can cut down on the costs, like I said, and then they're already doing the monitoring, so they can do it for both entities. So hopefully that'll pan out. We're working through that now. So in closing, I just want to reiterate that our SNP wind down is going well. It's on target to close all SNP projects by the end of next fiscal year and meet our deadline. And with that, I'm happy to take any questions.
Questions from board members? Good. Thank you, Stephen. Any other staff, Don, you want to bring up?
No, I think these are just the standard reports that we provide at every board meeting. I think the only one that is intermittent is the quarterly report that for third quarter actuals is in there as item E. And that's it. Nothing major to report out of that.
Melissa, I know I'm supposed to ask for comments from the public. Do we have any members of the public involved here? Can I ask or not ask?
Sure. Courtney, if you're there, if you want to give instructions to the attendees and see if anybody has any questions.
If anyone in the public has a comment to make, please indicate so by using the raise hand feature. Seeing none.
All right, thank you. And I think we have to give a shout out to Melinda Grant. Melissa, is that correct? Do we have a new?
Well, no. Actually, no. Undersecretary Grant joined the meeting as the representative for BCSH, replacing Lynn Von Koch-Levert, who was here earlier. So I just wanted to acknowledge that so it's in the record.
Yeah. Well, I just like to acknowledge the Undersecretary anytime I can.
Thank you very much, Mr. Chair. Thank you very much.
Good to have you.
Here, here.
Thank you so much.
And Mr. Russell, thanks for all that good work on VMT this week down in San Diego. I know you're part of that. Everyone, thank you. Thank you, staff. We stand adjourned. Bye, everybody.
Bye.
Bye.
Thank you. Bye. Bye.
Thank you.